Hey guys, back with another FAR 1 video. So today we're going to go ahead and go through dollar value LIFO. It's found in chapter 8. The page numbers are 405 through 409. So this first video is basically going to be a quick overview of basically what is going on, what is the concept, why would we use dollar value LIFO, all that kind of stuff. And then a second video will go through a complex problem that I created that kind of incorporates multiple different aspects of dollar value LIFO. So the first thing is, why would we use dollar value LIFO? It's more complex than just regular LIFO, so we have to have a justification for using it. The main reason for using it is because we can avoid a LIFO liquidation. So what is a LIFO liquidation? It's basically where you eat into old layers of inventory and you're matching prior period cost of inventory to revenues of the current period. We're going to go through an example of this. It may not make a ton of sense now, but we're going to go through an example of this in a minute, see how this affects us. But let's say we're in an inflationary environment. Okay, that would be bad. And the reason that would be bad is because we would have higher taxes. All right, everything else equal, we'll have higher taxes in an inflationary environment because if we have a LIFO liquidation versus if we don't, because what's going to happen is that these prior period costs would be lower than the current period inventory costs. And so if we're saying, let's say we have the same revenue, which is the example we're going to go through. Let's say we have the same revenue for both scenarios, but we're matching a lower cost, which is these prior period costs, against the current revenue. That means our gross profit and therefore our net income would be higher, which means we would pay more tax. Okay, so let's go ahead and walk through basically how that would look. Okay, so basically what happens here is I've just drawn out a quick example of how this would work. All right, so let's just get that all in there. So basically what we're going to do is, this is the end result and this is kind of the facts and kind of what we're going through. So what we're going to do is we're going to do a scenario without a liquidation and we're going to do a scenario with a liquidation. All right, and so the only thing we're going to change here is the amount that we purchase in 2017. You can see that it's 1,000 in the first example, but it's 2,000 units in the second example. All right, and so that's going to impact the amount of inventory that we have on hand at the end of the year, and that means that it's going to impact which units are costed into the cost of goods sold. So let's go ahead and go through this. So this beginning inventory is going to remain the same for both fact patterns. So let's look at that. Let's just say we had 2,000 units at $4 a unit. So we had 8,000 beginning inventory. Again, completely made up, completely just given numbers. Then we'll say in the first example, we have a liquidation. So that's this one right here. We have a liquidation. Let's say we purchased 1,000 units at $5. 1,000 units at $5. That means we purchased 5,000 of inventory. And let's go ahead and say we sell 1,500. All right, so now we need to figure out cost of goods sold, because that's going to be the thing that differs. Our revenue is exactly the same, okay? And we want the revenue to be the same so we can see the impact on gross profit and eventually what would become net income. All right, so what happens is that we got to calculate cost of goods sold. So again, we sell 1,500 units, and then we're doing LIFO, right? So if we're doing LIFO, we're doing regular LIFO, we would say last in, first out. Okay, sell 1,500. So 1,000 units must come out of these ones we purchased first, because those are the last ones we purchased, at $5 a unit. Okay, so that'd be $5,000, right? Then we would have to pull 500 units from our beginning inventory. These 2,000 units, we'd have to pull out 500, and that would be at $4 because that's the cost of them. And then we have 2,000. Okay, so that means we would have 7,000 total of cost of goods sold, which goes right there, and we can see our gross profit's 93,000. All right, now we're going to switch down to the scenario where we do not have a liquidation. We do not have a LIFO liquidation. All right, the only fact that's changing from up here is the purchases. The sales and the beginning inventory is exactly the same. So the only thing we're going to change is that we purchased 2,000 units at $5 in 2017. Okay, instead of 1,000, we're purchasing 2,000. Okay, so what does that do? Okay, that's going to change the cost of goods sold. We're still selling 1,500, so cost of goods sold, well, we have to pull out of these most recent units first for LIFO. So we have to say, okay, 1,500 units times $5 is 7,500. That goes right over here. And that means that our gross profit would be lower when we do not have a LIFO liquidation. Okay, if our gross profit is lower, yes, that's not as good in the sense that investors may not like that, But the main reason we're using LIFO a lot of the time is to avoid taxes. And so if we have a lower taxable income, we like that, right? Versus under the liquidation scenario, we have a higher taxable income. And so we'll see in just a second the reason for that, okay? The main reason we're having this LIFO liquidation is because we're eating into this beginning inventory, right? So what happens is that we actually sell more units than we purchase, right? So we can see, we're going to go through another example, but just to preview that, the reason we're having this liquidation is because we're selling more than we're buying, right? That's where the liquidation occurs, because then we're eating into these inventory units. By definition, that's the way LIFO works, versus within the non-liquidating scenario, we're actually purchasing more than we're selling, right? We're selling less than what we're purchasing. Okay, so that's when you would not have a liquidation. So let's go back over here, look at a quick LIFO liquidation example just to hammer this home, and then we're gonna move on to the next point. Okay, so again, I talked about kind of eating into these layers. So what does that mean? Okay, so this is a couple of year example I made up. Okay, so let's just say the company, this company, XYZ or whatever it might be, starts off in 2015, zero beginning inventory, okay? They end the year, ending inventory, with 5,000 units at $3 per unit, so they would have $15,000 of inventory. And this company is using LIFO, right? They would have to have a LIFO liquidation, and so that would be called layer one. If we build up a layer, meaning that we have a certain amount of inventory and we've paid a certain amount for it, that's called a layer, a LIFO layer, okay? Then and so the other thing to note is that this would be the beginning inventory for 2016 as well, right? So then in 2016, the ending inventory, okay, we can see that whatever happened, we don't necessarily know exactly what happened, but we can see at the end of the year, we still have this first layer, and then we've built up a second layer. What does that mean? That means that we've purchased more than we've sold, right? Because we have additional units in inventory, this second layer here, okay, and that second layer is priced at $4, it's 6,000 units. So that means it's 24,000. Okay, so now we would have total inventory of 39,000, but if we're talking about our LIFO layers, we'd have layer 1 at 15, layer 2 at 24. Then this last example here, this is where we get our LIFO liquidation in 2017. All right, so remember this is our beginning inventory for 2017. Then we look at the end of the year. Okay, we have our first layer, no issues there, but then we look at the second layer and we see that we actually only have 2,000 units of inventory priced at $4 left, which leaves us at 8,000, right? And so it's the same thing as we did in this other example here. Let's try to get these side by side. It's the same thing. This example here, right? The inventory in the second layer is lower than the beginning inventory. The ending inventory is lower than the beginning inventory, right? And that's the same thing that happens here. It's just that there's different amount of layers. So in this first example, right, we start off with 2,000 in our first layer of inventory for LIFO, and then we must end the year at 1,500, right? Because we purchased 2,000, or sorry, we start with 2,000, we purchase 1,000, then we sell 1,500, we have 1,500 left over, and that means that we're lower. We've eaten away a LIFO layer, which is that beginning inventory of 8,000, but under this other scenario, we have not eaten away a LIFO layer, right? We've actually built up another layer. We've built up a layer of 500 units at $5. And how do we know that? Well, we started off with this LIFO layer here, then we purchase 2,000 units at 5, and we sell 1,500 units, right? And we assume that those 1,500 units are the $5 units, which would mean that we'd be left over with 500 units priced at $5, and then we would also have the $4, the 2,000 units at $4. So we would have total inventory of 8,000 plus $5 times 500, which would be 2,500. So you would add that to the beginning inventory of 8,000, and you'd get 10,500 ending inventory. So that's the basic concept of dollar value LIFO. And then the other reason, this is the last thing really quickly, the reason that we can avoid these LIFO liquidations is because we use these things called pools of inventory for LIFO. And what happens is when we use dollar value LIFO, we're allowed to put more different items in those pools versus if you have specific identification LIFO, okay? And so what happens is, let's say that some items, the value of them goes up and then, or the cost goes up and then for one, and the cost goes down for the other, they can kind of offset each other. And so what happens is you can kind of pool these together and offset the increases versus the decreases. And that is the big advantage of dollar value LIFO, and that's why companies use it, to avoid LIFO liquidation. So thank you guys. Look for another video.